All right, let's move on to talk a little bit more about bonds. Our next guest says another big bond move is coming, and let's bring in Damped Spring Advisors CEO Andy Constan. Andy, welcome. Good to have you with us.
Thanks, Tyler.
What's that big move? Which way and why?
So, about last time I was on in August, we talked about the announcement of the issuance of long-term bonds, and that set the tone for the bond market for the last 2 months. Since then, we've also had strong economic data, and it's possible that that data may encourage the Fed to actually follow through with their hike. But with data out of the way, with the non-farm payrolls and CPI out of the way, the next big bond move isn't likely until the Halloween quarterly refunding announcement. And at that announcement, there is going to be a large deficit that needs to be financed. And Secretary Yellen holds the lever on whether she continues to issue the bonds that she did in August or shifts back to issuing bills. My sense is she will continue on the path of terming out the financing of the federal deficit debt, and that will mean large quantities of bonds. But regardless, we've had a 55 basis point increase in term premiums on bonds, and that's a big move. And so the next slug of bonds that the market has to absorb will likely not make quite as big an impact, more on the level of 10 to 20 basis points.
So okay, so if she's going to go and, as you say, choose to go issue bonds to finance the piling up of deficit money, and it's really shocking how much deficit money is needs to be financed. That would suggest that interest rates on longer-term securities are going to go up. By how much? Did I hear you say how much?
Call it 25 basis points.
From where we are now on the 10-year, which is what, 4.65-ish?
Yeah, and I wouldn't be surprised to see 5.25, particularly if the economy does sustain this relatively high GDP. So some combination of the economy not yet ready to turn over and this large supply could drive us into the fives on the long term, on the 10-year note.
What did you make of the inflation numbers yesterday? I mean, they were a little higher than I guess anticipated, but a little, just a little.
Yeah, I think the most noticeable number was the one that Chairman Powell focuses on. The month-over-month core services, ex-housing services, was 0.61, which was extremely hot, 7.2% on an annualized basis. And that is the number that time and time again, Chairman Powell goes back to as his services inflation measure. And it was warm. So, that's, we'll see how it plays out. But, for now, I'm focused on the next quarterly refunding to see, the supply-demand dynamic more so than the
I guess there'll be more numbers between now and the meeting in November. There could be a lot more geopolitics on the table between now and then. I wonder how the geopolitics plays into what the Fed might do. But I know Steve Grasso had a question for you. Steve?
So, Andy, bonds and stocks and the equity market have never been as correlated as they are right now, or I should say for a very long time. Do you see a world where the 10-year can keep rising and the equity market can perform, or is that just not possible?
So that's not my base case. My base case is that the increase in yields will cause multiples to contract. And, I'm sort of targeting 4,000 as a level to catch up with the bond market yield increase through multiple contraction. But at the same time, if the bond market is rallying, it's also possibly true and likely true that the economy remains strong. And that's part of the reason why bond yields are rising, which could have a positive on earnings. Unfortunately, consensus earnings still are for 12% annualized growth for both 2024 and 2025. So it's tough for me to get there because earnings are already discounted to be very strong. and there's this pressure on multiples.
You see 4,000 on the S&P. What is the time frame for that?
I think there's a lot of rhetoric around seasonals. Seasonals typically leave the market quite strong. When the market's up 10% or so, like it is, you get a rally into the year end. But that's typically due to the fact that the winners are deferred till next year to be sold to avoid crystallizing a taxable gain. This year is so narrow in its leadership. The taxable gains are so narrow, and the bond market is providing a tremendous amount of capital losses to harvest that I don't think that delayed selling will necessarily occur. And if the supply and demand is normal, not this deferred sense, the Santa Claus rally is pretty unlikely based on the work I do.
All right, Andy, thanks so much for spending Friday evening with us. Andy Constan, we appreciate it.